It's a perfect day, actually, to catch up on your thoughts on the City of London and what it means in general for UK assets. Have they become more attractive since the Windsor Framework? There are still a lot of questions on if this can be passed through.
I don't think they were unattractive before the Windsor Framework, but there's no doubt the Windsor Framework is positive for sentiment in terms of overall relationship between the EU and the UK, and that must be good on a number of dimensions, not just sausages in the Irish Sea, but actually on all aspects, and financial services being one of them, in terms of trade and other areas of cooperation. And I think you saw a real thawing of EU position and UK position over the recent days and the negotiation of the framework. And so I think that's the positive. And even before that, though, I think overall we were very positive on the sort of post-Brexit position, particularly of the UK, and focused in the EU on the things that the EU needs to do to build its own sort of capital markets and depth of investor markets.
What gives you that optimism around the prospects of a post-Brexit Britain, given the economics, given the data pointing to the damage? And do you think that Rishi Sunak has done enough? Can we put that risk premium behind us now? The Liz Truss risk premium, has he dealt with that? Is that now in the past?
I think we need to break things down on that, because I think what happened in September actually, in terms of the debate around, is it growth, is it taxation, is it the budget, they're things which are perennial that governments need to deal with, and I think Prime Minister Sunak and Chancellor Hunt have to deal with those in the upcoming budget. But I think what remains very positive in the UK is the dynamism of formation of new sectors and new economies. It remains a place of material venture capital and seed investment. And it's one, I think, which we can point to and sort of say that will continue, those conditions. The talent in the UK is extraordinary. The universities are very strong. And so I think those stay constant. They have nothing to do with a Windsor Framework, but they are certainly not harmed by there being better relationships between the UK and the EU.
And you're spending tens of millions of dollars, I think, revamping your London offices, right, in Canary Wharf. So you've always been bullish on London. How's that going?
Very well. We're spending a little bit more than that. As you can imagine, a 42-level tower is quite expensive to refurbish. But it is a complete statement, not just the acquisition 4 years ago of that building, but also the major refurbishment. It is an absolute confirmation of our confidence in London as our regional headquarters for EMEA, and a statement about our confidence in the UK.
And beyond the UK, last year, Europe produced some of the biggest revenues, the most revenues, in fact, for the institutional part of the business. Does that continue? What was driving that?
I think, and I'll just correct one thing, it was EMEA, not just Europe. I think we all know about the volatility in markets, particularly energy markets, that came as well as equity and debt markets. And I think the depth of the markets in Europe and the challenges that clients face and that need assistance with, whether it's risk transfer, whether it's capital management, whether it's advice, whether it's capital raising, those conditions remain. And the thing about EMEA, of course, is you've got big developed markets like Europe and the UK, but you've got very strong emerging markets in the region, Middle East in particular, where there's enormous, not just capital, but also restructuring of economies happening, which are really triggering some very interesting opportunities for our clients. And then, of course, Africa, which is if you like, the not-so-sleeping giant for the next stage.
David, what are deal volumes actually looking like in EMEA? Because if you look at Bloomberg data, it shows that basically this region, or EMEA, is falling. Deal flows are falling faster than the rest of the world, and I don't know if there's an underlying concern on that.
Overall, if by deals you mean M&A transactions or capital raisings,
or IPOs,
IPOs, yes, they are at a lower level. However, we see, and this isn't just sort of normal optimism, we genuinely see a backlog building and particularly of strategic dialogues. And one of the things which all our clients are looking at this year is, yes, we've got the variables of interest rates and inflation and how is quantitative tightening going to impact it, but what will happen to corporate profitability and what are the decisions that they need to make, whether it's consolidation, whether it's divestment, as a result of what's happening to their own performance. And they're the conversations which are very live right now with our clients.
I want to bring it back to the China question, David. I know you've got views on this, because you're getting a dueling narrative now out of Beijing. You've got Xi Jinping doubling down on party control across the government and corporations. Once again, we know that is intrinsic to his views about the direction of travel for China. But at the same time, I talk to businesses operating in China, foreign businesses. They are being courted like never before by Chinese officials, say, please invest now that we've reopened. The decoupling, the ability for your clients to invest in other regions, to diversify, how much of that is a potential opportunity for you at Citi? How do you ride that?
So we are, as your question implies, the most global bank, and so we have a network in 100 countries around the world. There are two dimensions, I think, that are going on. One is that the private sector in China, so the domestic private sector, is also being re-encouraged to be investing significantly. So you have the benefit both of the inbound encouragement, if you like, and that is a change in tone, as well as the private sector in China being encouraged. So we remain positive, therefore, on the dynamics within there. However, there is definitely a recalibration of global supply chains, which is happening and has been happening since COVID, accelerated by the war. And our clients are moving and changing their concentration of their supply chain away from China. That will be a multi-year, decadal type trend. And we're seeing places like Mexico, like Vietnam, others benefiting very significantly. And that's something which we can assist with wherever our clients go.
But, I mean, these are supply chains. What about the real stuff, the rare earths, the chips? Is that also going to move away from China?
Yes, is the short answer. One of our clients during the pandemic thought they had, an automotive manufacturer thought they had a very diversified supplier base because they had 5 top-tier suppliers. Well, they didn't realise is those top-tier suppliers were all going to the same supplier of chips in China. Right. And so there was no diversification. I think our clients are now much more concentrated, particularly in critical elements, goods, materials, mining, metals, that they have a genuinely diversified and deconcentrated supply base.
What is the revenue potential for Citi from this diversification then that you're seeing? How do you lean into this?
Well, we move trillions of dollars from our clients every single day, investor clients and corporate clients, and as they go through their recalibration, opening new businesses for them, opening new accounts, managing their capital around the world, managing their capital expenditure is something that's innate. That's what we do. And I think the greater diversification plays to the network strength that we have.
Dave, talk to us a little bit about ChatGPT. So I know you're amongst, you're one of the many Wall Street banks that have banned this. Is this because of regulation? Could it come back? It's unclear the relationship banks will have with this in the future. It's
not really about regulation. I think it's about our own judgment about what we allow inside our systems. And you can imagine something which is very, very new, only just been released. Its applications, generally, but particularly we need to be careful running financial services systems of what we allow in. So we'll sort of see how it develops externally.
What are you worried about?
Worried about the stability. It is just as we know, it's a predictive tool that picks the next word that's most likely. If you wanted to use that for coding, is that going to actually result in better coding than you've actually got with your current people and current systems? And so I think it's far too early to sort of be relying on something like that in a critical systems architecture.
Does longer-term generative AI become the future of finance, 10 years out? How central will it be?
We don't know. And I think it's definitely one of those things which you absolutely need to be on top of in terms of development. But it also has, the nature of AI, it is automated and has machine learning inside it. We need to know how that's going to behave and how it's going to control. So I don't think we can predict that it's definitely the future.